All right, hello, welcome to the Weekly Outlook, your weekly deep dive into business, tech, and economic stories shaping our world. I'm your host, Josiah. We're coming to you mid-July 2025, and the market is feeling a little tense. It's like it showed up to a party expecting a chill DJ, but got a heavy metal band instead. The band, in this case, is a flurry of tariff threats, and the entire investing world is trying to figure out if it's time to headbang or head for the exits. This week, we're untangling that tariff web and what it means for your wallet. We'll celebrate a tech titan joining the most exclusive club in financial history and look at a strange new epidemic in Japan caused by the very device you might be watching this on. Plus, we'll see which sector is feeling the heat as earnings season officially kicks off. Let's get into it. All right, let's talk markets. On the surface, the numbers weren't catastrophic. The Dow Jones finished the week down 0.5%, with the S&P seeing similar drops. But those numbers don't tell the whole story. This wasn't a slow drift down. It was a week of nervous nail-biting, and it all comes down to one word: tariffs. President spent the week rolling out a new playbook on trade. The big headline: a plan to slap a hefty 35% tariffs on imports from Canada and raise rates of 15 to 20% on most other countries, all kicking in August 1st. So what does that mean in plain English? It's a negotiating tactic, sure, but it's one with real consequences. That Canadian maple syrup, the parts for that American assembled car, the materials for new construction could all get more expensive. Businesses are forced to make a tough choice: eat the cost and hurt their profit margins, or pass the cost on to you, the consumer, possibly spurring inflation. Is it a one-time bump, or is it a continuation of increasing prices? This puts the Federal Reserve in a tough spot. They want to cut rates to stimulate the economy, but if tariffs push inflation higher, their hands may be tied. But while the broad market was wringing its hands, the AI boom continued its victory lap. NVIDIA, the undisputed king of AI chips, did something no company has ever done before. It smashed through a $4 trillion market capitalization. Let that sink in. It's a testament to the sheer momentum behind the AI revolution, a force so strong it's defying the gravity of geopolitical tensions. In another corner of the market, Bitcoin surged to a new record high of over 118,000. While mainstream assets trembled, crypto investors were partying. It seems in a world of uncertainty, some are betting on digital gold. Now let's zoom in on specific stories moving the needle. Here are some developments around the globe that could impact your investments. As we just discussed, tariffs are the story of the week. President Trump has just sent letters to over 20 countries outlining new rates. Besides Canada's 35%, Japan and South Korea are looking at 25%, and Brazil could face a staggering 50% tariff. This has a ripple effect across the entire market. The industrial sector is on high alert. Companies relying on global supply chains could see their costs soar and operations disrupted. The consumer discretionary sector is also vulnerable. Higher prices on imported goods means that less spending for consumers. Think electronics, apparel, and cars. We're already seeing specific companies get hit. Shares of Dayforce, a software provider with a significant Canadian presence, fell over 5% on the news. This is just a clear-cut example of geopolitical risk hitting a company's bottom line. It's official. NVIDIA is in a league of its own. This week, the AI chip maker became the first company in history to be valued at $4 trillion. This isn't just a win for NVIDIA. It's a massive confidence boost for the entire tech sector, especially for AI-related stocks. Companies like AMD, which is developing competing AI chips, saw its stock rise on NVIDIA's wake. A rising tide is lifting all AI boats. However, it also concentrates risk. The S&P performance is now incredibly dependent on the handful of mega-cap tech stocks. If NVIDIA sneezes, the whole market might catch a cold. Keep an eye on other giants like Microsoft and Google to see if they can keep up the pace. Here's a story that feels a little bizarre and completely inevitable. The South China Morning Post reports on a growing health crisis in Japan, acute esotropia. Kind of a hard word to say. A sudden onset of crossed eyes, dubbed the smartphone squint. A recent study found that the highest portion of patients are middle and high school students, a direct result of spending hours staring at screens up close. Well, the very knit health story has a surprising broad economic reach. Is a potential boom for healthcare. Vision specifically. Think eyewear companies, optometrists, and specialized ophthalmology services. Could also become a major environmental, social, and governance issue for tech companies. Will we see more pressures on firms like Apple and Google build hardware and software that actively mitigates eye strain? Think of it as the next evolution of screen time warnings, potentially mandated by governments. Who knows? We shall see. Because earnings season is here. The second quarter financial reports will start rolling out this week, led by big banks. JP Morgan, Wells Fargo, Citigroup, Bank of America are all on deck. The entire financial sectors will be under a microscope. These banks are the heartbeat system of their reports will give us first data on consumer health. Are people still paying credit cards and bills on time? Are they taking out loans? From a business perspective, are companies borrowing to expand, or are they tightening their belts in fears of slowdowns? Well, on the news, reaction is a real possibility. Expectations have been managed down, but any sign of weakness could really spook the market, and it's already nervous. Speaking of big banks, JP Morgan made a move that sent shockwaves through the fintech world. They plan to start charging financial tech companies for access to customer data that they previously for free. The immediate victim, PayPal. They fell nearly 6% on the news, making it the biggest loser on the S&P on Friday. This is a power play. It directly impacts the fintech space. For years, nimble fintechs like PayPal and Block have built slick apps on top of traditional banking structure. JP Morgan is now reminding everyone who owns the pipes. This could dramatically increase operating costs for fintechs and squeeze their margins, potentially stifling innovation or leading to a consolidation in the sector. He has settled with a Canadian father who tragically lost his entire family in the 2019 737 match. This settlement came just days before the first trial was set to begin. For Boeing, settling removes a massive emotionally charged legal uncertainty. It allows the company to continue to move past one of the darkest chapters in history. For investors, this closes a major liability, which is a net positive for the stock. However, it's a somber reminder of the human and financial cost of the 737 MAX crisis and the long road Boeing has traveled to rebuild trust. Our last story, a strange tale of corporate espionage from China. A man was jailed for spiking his colleague with a sedative, a so-called to steal a work plan. Sounds like something from a spy movie. It highlights a very real and growing theft. Intellectual property theft. This is a tailwind for the cybersecurity sector. While this was a physical attack, the motive is the same one, digital espionage. Companies are pouring billions into protecting their data, benefiting firms like Palo Alto, CrowdStrike, and others. It's a reminder that the biggest threats to a company's future aren't always on the balance sheet. Favorite show, the stat of the week. This week's number, 118,900. What is that? Record high price. 1 Bitcoin fetched on Friday. To put that into perspective, for the price of a single Bitcoin, you could buy a brand new Porsche 911, or you could make a 20% down payment on a $106,000 home. In a week where traditional markets were gripped by fear, the world's most famous cryptocurrency was hitting all-time highs. It's a volatile, unpredictable, and utter fascinating asset. Whether you see it as a future of finance or a speculative bubble, it's a roller coaster you can't help but watch. Week's recap on S&P. The S&P closed at 6259.75, which was down almost 0.5% for the day. While a red day is never fun, the broad technical picture remains constructive. The index is still in a rising trend channel, suggesting the long-term path of least resistance is still up. There's very strong underlying support around the 6120 level. Break down the key indicators that I've observed. Support levels 6120, 6020, and 5920. Any breakdown below 5920 would be considered negative. The highs were 6290. Is a potential resistance, although weak. We really don't have a resistance level to consolidate to. That said, you could look at VIX and determine what the implied volatility is and go from there and make a prediction, but that's just it. It's just a prediction. Market breadth remains very strong. VIX remains relatively low at 16.5. All of this is indicating bullish buy. Our put call ratio is 62 and still falling. Until that rises, that will not be a sell signal. MACD is bullish, but it's weakening. RSI still around 69, although considered near overbought. Overbought does not mean sell. And moving averages, S&P is way above the 50-day and 200-day moving averages. So the picture is cautiously bullish with EPS rising, now a little over 280. This puts forward PE at 22.4. It's time to be cautious, but the long-term trend is still undeniably positive. However, a short-term pullback and neutral oscillator readings suggest the market may need to consolidate before its next leg up. The risk of a deeper pullback towards support exists, and as they say, the trend is your friend until the end. Given its nature, a strategy that profits from time decay and a rising or sideways market is ideal. A potential play may be a bull credit spread. There are a couple of places you could put the bull credit spread. In looking at the chart, there is places you could consider a spread. One would be here, and another, this would be maybe just a few days out, maybe 14 days or so. One, here's a very strong support level at this point. I may consider, depending on what the week holds, I may wait for the market to pull back just a little bit. And once it pulls back and I get a confirmation trend up, volatility will be higher. I may consider selling a bull spread here. We'll take advantage of theta. I may place this for about 30 days out. It'll take advantage of theta. And if the market goes down slightly, it even goes up as long as it stays above, let's say 61.10, that might be where I put this particular trade. As long as it stays above there, I get to keep the premium. For the week, the big takeaway, we're in a market of contradictions. Fear over tariffs is clashing with the unstoppable optimism of the AI revolution. Uncertainty is the name of the game, and the next week's inflation and bank earnings will set the tone for the rest of the summer. Thank you for joining us. We're here to help connect the dots in a complex world. Soon, I'll publish another video on the strategy I used last week, where I had a 100% win rate, and it's about selling puts during earnings season. Stay informed, stay curious. Remember, this is not financial advice. Always do your own research, and we'll see you next week. Happy trading.